Resurgent India Limited is a SEBI-registered Category 1 merchant bank established in 2005. We help financial institutions identify the right business entities and work with businesses to secure the right amount of capital at the right time, fostering stronger enterprises and a more resilient economy and society. With over 300 professionals and a nationwide presence, we are market leaders in debt syndication and stressed asset advisory. Resurgent offers a 360-degree service model, supporting businesses across their entire financial life cycle, from project appraisal, valuations, and regulatory compliance to capital raising for early and growth stage companies, and further, to stress resolution and insolvency advisory. We are with you at every critical stage. Tailored solutions to meet your needs. Resurgent India Knowledge Series presents live webinar on India's securitization, market opportunities, trends and road ahead. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers: Mr. Vinod Kothari, Director, Vinod Kothari Consultants; Mr. Vineet Jain, Senior Director, Care Ratings Limited; Mr. Achinto Bhattacharya, Deputy Vice President, Securitization, Catalyst Trusteeship Limited; Mrs. Harini Anand, Chief Financial Officer, Geo Credit Limited.
Good evening, friends. I am Ashish Agrawal from Resurgent India. I would like to welcome all of you in this today's conference or webinar, I'll say online discussion on a very, very important topic in the current scenario, that is on the securitization current scenario and the road ahead. This is the topic of today, and we have very good panel speaker, esteemed panel. Those are I'll say, pillars for this kind of assignment or this kind of securitization which we are discussing. So we will discuss in detail about the current scenario and the future of the securitization. I would like to welcome all the panel speakers, Mr. Vinod Kothari, who is the encyclopedia of the securitization industry. And he wrote many books also, and I think he has advised to many companies also. Then we have Mr. Vineet Jain, who is head of securitization in Care Ratings. He has very vast experience of the ratings side on the securitization. Then we have Mr. Achinto. Mr. Achinto is the DVP of Catalyst Trustee. So trustee is also playing an important role in the securitization. And then we have Miss Harani, but I think she will not be in a position to join because of some urgency at her home. And she is the CFO of Geo Credit. So we have panel speakers, they will discuss. Then we have audience also. We have very good audience also from the diverse background. We have people from banking, from NBFCs, the professionals and other practitioners. Not only domestic, we have many DFIs also, multilateral financial institutions also. They are looking to enter into the securitization of PTC market India, or some of them also started it actually. So they want to understand what is happening and what is the future plan of this actually. So I would like to once again welcome to all of you for joining with us. And I would like to request to all the audience that please make it more interactive. We'll be happy to take your questions, whatever questions you have from us. We'll try to cover up. It will not be possible to cover up here. We will cover up later on. We'll send you the reply after taking the answers from the panel speakers. So this is the brief about the discussion which we want to have. And before inviting our panel speaker on such an important topic, I would like to run through a small PPT just to set the tone of the discussion, so that we should know that where we are and what is the future from the regulatory point of view, or from the numbers, mainly the statistical number in last 3 4 years, what has happened and where we are today also, and what is the future of it actually. So I will request to Resurgent team to please present the PPT here, so that we can run through it quickly, and then we can go for the panel speaker discussion. So next slide. So, sir, if we see this in the securitization market growth, this overall, this first half of this year is looking good actually. And there is a increase, something around 8% increase, overall increase in the volume compared to the last year, the same period actually. And we see that this is from the NBFCs and some large corporates also. And along with that, we see the PTC is dominating in the overall current year growth. So 60% is PTC and 32% is the DA actually. So this is a discussion point which we'll discuss also, that what has changed actually. And CLM is one of the more important area which need to be discussed. Although CLM is not a part of the today discussion, but we need to understand with the new guidelines which will be applicable on 1st of January 2026. There are certain changes actually. Whether this will impact this market or not impact, that also we will try to understand from our panel speaker, because you see that the RBI has changed some norms. One is that CLM one will only be applicable. Then the skin in the game, earlier it was minimum 20% retention of the portfolio by the junior partner. Now it is 10%, minimum 10%. So will it be a game changer for the securitization market by way of CLM? And then we will discuss the other part of that, this thing, which segment of the portfolio will be the backbone for the securitization. If we see in last 6 months, the vehicle, vehicle is dominating, wheels portfolio is dominating, and there are certain risk factors are there which have been seen in the market, where the personal loan and MFI loans are having a little higher default rate actually. So will it impact the overall securitization market also? Yeah, next slide. So we see these numbers in last 5 years. This is just a graph. So we were there at 1,19,000 crore. Now in this was the full year number in 2020, and in 2026 half year we have crossed that number actually. So practically we see that growth rate is very very good actually in terms of the numbers. And even H1 also, numbers are very good actually in comparison to the last year. So this year growth looks good actually from the first half point of view. But let's see that how the year will end actually, and what are the views of our speakers on that also. In terms of the split of the portfolio, we see, uh, sorry, in terms of split of portfolio, the I think again the wheels has taken the lead actually, and then the rest, the other portfolios are there, which are a part of the overall DA transactions. Next slide. So there's, as I told you that yeah, we see majority of the portion is in the overall this thing, the wheels portfolio. And, rest is so major is the PTC actually, if you see, and the rest is DA. So this number is now changing drastically. Yeah, next. So this is just a table that what is the difference between DA, PTC, and the CLM. So all these three products are having the different characteristics from the regulatory standpoint of view, compliance standpoint of view also, and the risk point of view also. So if I see major actually from risk point of view and the credit rating point of view, I think only in PTC the credit rating is compulsory, but in other areas the credit rating is not compulsory, and the credit announcement is also not allowed in the DA portfolio. But in the PTC and co-lending, this can be possible, but co-lending also now this is restricted to certain extent only. As per the new guidelines, the up to 5% of the FLDG can be given actually. So these are certain areas which I think which are important to understand when we are discussing the DA, PTC, and co-lending. And these are the areas which will impact the overall growth of the sector also, or the securitization, keeping in mind that how we are working on these areas actually. Yeah, next slide. So if we see road ahead, actually, this I think CLM will let us know in next 3 months that how it will shape up. Although there will not be a big change, but definitely the CLM new guidelines where they have made it 15 days, maximum 15 days for the settlement of the portfolio, whatever the portfolio we are giving in the CLM, within 15 days it should be given to the junior senior partner. So this is something new which has come, whether the NBFCs will go for the CLM or DA. And if we see the overall growth on the DA side, that maybe because of the CLM challenges, this DA in fourth quarter may be more actually, rather than the CLM will take off actually. And this new baby has come into the system, and one I think one listing has also happened in the RMBS actually. We will discuss with our speakers also that what is this new thing in the overall securitization market actually, and this new entity has been formed by the NHB also, and people are hoping that there will be a big change in this because of this also. And there are new things also which have been announced by the RBI or SEBI. As these new draft guidelines have come on the stress asset securitization. This SSAF might be a new thing, and green PTC, which is again for the EB portfolio or green portfolio, which can be securitized also, which is currently very nascent stage, but definitely in future it will take the shape also in the overall securitization market actually. So these two things are there, which are rather three things actually: RMBS and the SSAF and the greenium. These three things are there, which will definitely we'll discuss maybe next year. These things will have these some kind of numbers to deliver or to discuss that what change has happened actually. And then this credit growth and credit deposit ratio will also decide in the last quarter this thing, that how this will shape up, whether the bank will use it as a balancing tool, or this will be a real journey for the securitization. Yeah, next slide. So thank you so much. So I think this is something which we thought let us just present so that it can set the tone of the discussion. And now I would like to invite Vinod Kothari ji. So Vinod Kothari ji, as everybody is aware about him actually. He wrote many books, and he's practicing securitization. So I'm very happy that today we have a very good panel actually. These three agencies are there. One is that the legal or consulting firm which can advise you on the right side of the securitization, and the rating agency and the cash trustee. So these three agencies are playing very important role in the overall securitization, and we have all three actually here. So you will get the comprehensive view from all of them actually. So Binod sir, first of all, I would like to welcome you, and I'd like to understand from you your thought process about the securitization currently, the future, and how do you think that this will change the overall dynamics of the this new regulation, and the tightening of the norms also will help in the overall growth of the portfolio, or it will reduce the portfolio growth in the securitization, or what are the risk factors which are there in the overall securitization which you perceive or which you see in the current scenario, sir? So over to you,
Right.
Vinod, sir.
Thank you, Ashish ji. Thank you very much for A, the kind words of introduction, and B, for giving such a beautiful context of the entire securitization landscape. You mentioned we have three panelists representing three different sides. In fact, there are four. The fourth one is one of the significant investment placement agent, and that's Resurgent, and you are representing that side. So that makes it actually four, which makes it a very complete panel.
Thank you, sir.
Sashiji, your contribution in securitization, including lots of other things, is commendable. So over to the question. So in terms of a quick backdrop of how regulations and changes are shaping the securitization landscape in the country, we must understand that in India particularly, regulation plays a very important role in the way the business develops. And this is seen right since the RBI brought the first set of guidelines in 2006. 2006, as you might recollect, the first set of RBI guidelines came that dealt with securitization only. It did not cover direct assignments at all. And therefore, the easy route for people was to pick up a direct assignment window, not to do a securitization, go for a direct assignment. And therefore, the entire market shifted to so-called direct assignments. In 2012, after the global financial crisis, RBI tightened the rules and covered direct assignments as well. There, people had a choice to go for securitization or to go for a direct assignment. But in the meantime, there was a taxation issue, which basically arose from the mutual fund industry, and income tax officers started taxing the mutual funds for the pass-through income that they were passing over to investors. That once again led to a complete exodus of the mutual funds, and the market once again shifted to D. In 2016, that problem was resolved, and therefore the market once again started choosing which of these two should be appropriate. In India, as I'm sure everyone understands, that large part of securitization is accounted for by the demand for priority sector loans. To the extent the loans are PSL qualifying loans, for a bank, it's very easy to buy a PSL loan portfolio by a very simple, convenient direct assignment route. So if it's PSL, the choice quite obviously is DA. If it's non-PSL, then the market might look at, well, it's something where I need a credit support. It's something where I need opportunity of exit as well. It's something where I might involve a non-financial entity also as an investor. Therefore, that's where people choose the so-called passive certificates. So the regulatory changes have been very responsible for the way the market has been shaping up. In 2021, as the RBI came with the new so-called SSA directions, which separately split the regulatory framework for transfer of loan exposures, and one separate direction for the transfer of for securitization of standard assets. Now, of course, in 2025, the RBI has done a major consolidation exercise where all regulations have now once again been consolidated entity-wise, and therefore there is a new set of transfer and distribution of credit risk TDCR regulations, one set for commercial banks, one set for NBFCs, one set for AIFIs, one set for SMBs, and so on. So there's a major consolidation come subdivision exercise by the RBI, and I'm sure everyone must now be struggling to find where is the regulation setting in the new set of regulation. That's quite a task. All day we keep finding where is the particular regulation board. So it's now we are into a very interesting time where not just RBI direction, but whole lot of laws are being rewritten. Income tax is rewritten, Social Security Code is rewritten, RBI is written all the directions. Insurance Act is going through a major change. SEBI has rewritten several regulations. In fact, the Securities Market Code itself is rewriting the entire security law itself. So a lot of, revamping of regulations. Let me just turn back to the theme. Ashish's point was number one, to look at what are the major regulatory changes which will shape the market in time to come. I would surely like to talk about at least two very significant regulatory changes. Of course, in terms of market dynamics, we'll talk subsequently. But two major regulatory changes. Number one, the change of co-lending directions. Ashish ji himself in his presentation talked about the new co-lending framework, which is supposedly becoming mandatory from 1st of January. Earlier, people were expecting there'll be some kind of deferral. I don't think, frankly, there's any deferral. Might be reasonable to expect in deferral at this stage. In fact, several companies have already started pre-implementing the new co-lending directions. So what the new co-lending directions do is that earlier people were taking co-lending as the very simple route to avoid DL, direct assignment, because co-lending used to be, I mean, much easier as there is no minimum holding period required. One could probably also think of some bit of credit support in co-lending transactions. So people were using co-lending as a simpler route out of DL. Now that co-lending itself has a significantly changed framework. There is a credit support possible, but up to a limit of 5%. The minimum risk retention is brought down to 10%. However, it's also clear that you cannot do a so-called discretionary co-lending, because the loans have to be mandatorily picked up by the co-lending partner once they are originated. There's a 15-day operational time period. That's more for operational convenience, not for the exercise of discretion by the co-lender to buy or not buy the loans. So that's a major change, and therefore people would once again come back and discuss whether, if I'm actually wanting the benefit of hindsight, if I'm actually wanting to pick up those loans which I want to pick up, I would rather go for a direct assignment, because if I go for co-lending, I'm bound to take the loans which have been originated by the co-lending partner. Originating partner has originated loans, I'm bound to take it. If I want to test and then select what loans will I want to pick up, then I would rather go for a direct assignment. So I think there is a very compulsive reason to relook at direct assignment post 1st of January. That's one regulatory change Ashish ji has already talked about. There's another regulatory change which is, in my view, very significant. Of course, it's not received the kind of attention that I think it should deserve. This is a new set of regulation which the RBI brought on the 5th of December. It's called Financial Services Directions. Of course, commercial banks, financial services directions. What it actually goes to say is that if there is a bank and there is an NBFC also in the part of the banking group, this is basically directed towards banking group. And I'm sure everyone would agree that in India, most of the commercial banks also have other entities. For example, a bank has an NBFC, a bank has a securities trading company, a bank has an operating entity, etc. Banks have various so-called group entities. If the bank has there's a banking entity and there's a non-banking financial company, the bank is supposed to make a board level choice of what product will be offered by the bank departmentally and what product will be offered by the NBFC. Therefore, the bank decides, for example, vehicle loans will be offered by NBFC and not by my bank. Home loans will be offered, say, by the HFC, not by the bank. LAP loans will be offered, let's say, by the bank, but not by the NBFC. So the bank has to decide which product will be offered by which entity. Once the bank has made the choice, it becomes a board level sort of allocation of businesses. Assuming that the bank decided that vehicle loans will be offered at NBFC level or home loans will be offered at HFC level, then is it possible for the bank to then buy that portfolio by a direct assignment window? If the bank had chosen that we will not do home loans will be done by an HFC of the banking group, then the option of buying the loans also subsequently would not remain, because that's a board level, I would sort of broader allocation of business. And therefore, to my mind, the only route for the bank to therefore acquire a stake in the home loan or vehicle loan portfolio will be to invest in pass-through certificates, because D option will get ruled out. Co-lending also will get ruled out, because the bank has made a choice that we will stick to, for example, commercial loans, vehicle loans will be done by the NBFC, home loans will be done by the HFC, etc. Then the only way for the bank to, kind of acquire portfolios originated by those group entities will be through a direct assignment, will be through a PTC route, neither by direct assignment nor by co-lending. This is a very new regulation. I think banking boards probably, as they meet in the month of January, I'm sure they'll take note of this very, very significant regulatory development. As we speak, a lot of banks are trying to evaluate as to what this means. It's not a bolt from the blue, because draft regulations were there in October 2024, but the final rule has come only on 5th of December. So this also going forward will shape the market, Ashish ji. So I guess this is a short background as to regulatory changes which might shape the market in time to come. But Ashish ji, I'm sure we'll like to hear Vinit ji and yourself and Mr. Chintu as well, in terms of how the undercurrents in the market are looking currently. You talked about the growth in volumes in the first half of 2026. You said there is an uptick, there's a rise in the volumes. And I'm sure we also need to note that there is one transaction which is itself worth 20,000 crores. If you were to take off that,
Correct.
then probably the market has actually shrunk, I think about 6-7% reduction in volumes. But Ashish ji, over to you and Vinay ji for
Thank you, sir.
further
Thank you.
inputs on the market dynamics. Sure.
Thank you, Binod sir, for giving the background from the regulation point of view, and you very well articulated the entire ecosystem. So now I'll come to Viniji. Viniji, welcome to you. And
Thank you, sir. Thank you
Viniji,
for
you
inviting us to
are.
the event here.
Thank you, sir. Thanks for joining at very short notice, actually. But Viniji, as you are practicing securitization and rating agencies are playing very important role actually, because any transaction on the PTC side without rating agency it cannot complete actually. So you know the pulse of the market also, you know the banking thought process also. So if we see the Indian securitization market, actually it is based on the CD ratio. Sometimes this pressure is there, then the banks are going for this. So it's a kind of balancing tool rather than the structural approach for the long tenure assets actually. Like in US, banks are taking as a one product actually for the long term asset point of view. So as a rating agency, what is your view on that actually? Whether this will be like that only, or there will be shift also, and what is the difference between the India and US market also? So whatever comment you want to give on that, actually, this is a very important part which need to be discussed. Otherwise, it will always be dicey that sometimes the CD ratio will be in pressure, then there will be more securitization will not be, then there will be less securitization. So how the industry should define, sir? Over to you.
The interesting questions are there are multiple questions that you have put in one question. Most important that we keep facing when we talk to investors and even when we go to the committees is comparison with the US market. So what happened in 2008? Why do you think that that will not happen? And that always is a question in the minds of trade people, including the regulators. So that's one question that people still are not able to overcome, right? When you look at US market, US market from 2008 volumes came down. Volumes in US market are now probably back to what it was or more than what it was in crisis of 2008. So US market has probably gone behind the 2000 subprime crisis. Whereas in India, we still keep discussing what happens. Can a scenario similar to what happened in US feasible? So first is, I don't think that kind of scenario is possible in India. The kind of distress that we saw in the US market is less relevant for us for a couple of reasons. One, if you look at investor side is not that aggressive or that more mature, right? We still have basic credit matrices, basic credit appraisal, which goes into the decision making, and people are a bit averse to complex structure. So when you talk of US market, in a secured asset transaction, we have 10, 12 series of PTCs. India, we have seen maybe two or three, maximum four, again, very rarely, right? So the level of complexity that US market has and what Indian market has is completely different. By regulation, again, though after the subprime crisis, the derivatives have been disallowed in the securitization market. So you can't have ABS backed by ABS. So you could have other sorts of hedging mechanisms in the transactions, but you can't have ABS backing another ABS. So re-securitization is something which is not allowed in India. Another difference which you find in India that although we keep talking of subprime asset classes, subprime lending, right? Barring a very small section, right? Most of the lending that happens in India is backed by the productive purposes, and that is by regulation. RBI says that your lending has to go productive purposes, right? And assessment of cash flow happens invariably in all cases, right? So market is fundamentally different when we compare this with the US market when it happened. Interestingly, even in the US market, if you look at the subprime crisis, right, the crises were limited to very small section of the structured market, right? It was not that everything exploded. The RMBS is not exploded, but much of RMBS is not exploded. 80-90% of the RMBS market in US will be backed by agency. Agency RMBS is basically you have Fannie Freddie which guarantees the entire portfolio. So that's a quasi sovereign risk that we have in the US market. and that also to some extent drives the volumes there, right? You asked question about how the market will develop, how does it compare, how do you see the market? Now, for market to develop, there has to be commercial incentive for people to operate, right? If you look at US market, the RMBS is quasi-sovereign risk. So typically you get funding, which may be probably better than the triple A risk that you have, and that drives the market there. When we talk in the Indian context, triple A issuers, right? What is the incentive for triple A issuers to securitize the assets? A, we have a mindset where we want to hold on to the assets. Our valuation, our KRAs, the way it is designed are largely on the AUM basis. So, A, what is my incentive to securitize the asset? And that is why you will find that most triple A entities, right, are not there on the sell side. They are probably on the buy side only, right? So, what incentive do they have? Like even Vinodji mentioned that bulk of the market is driven by PSL, right? Why is PSL driving the securitization volume in India? Again, it has got a commercial reason behind it, right? PSL assets demand a premium, right? And with that premium, it is become efficient for the borrower or the originator to raise resources, right? Because you get PSL premium. So most of the volume that we see in Indian context is driven by the PSL premium for the asset, where there is cost of funding advantage, right? So if you look at double A plus or triple A rated issuers, that is what their motive is, right? Broadly, you can say that there are two motives for most of the players. One is people who are looking at doing PTCs, they are largely doing it for rate benefit, and that rate benefit primarily comes from A PSL and B, for a lower rated entity, this comes from the rating upliftment for the PTCs. Second is your player who are more active on the direct assignment side. Their motive is largely capital relief, and very few people also have the motive to book profit upfront. So these are the two drivers when we look at the Indian market from the incentive for the originator. From the perspective of RMBS, we have seen one transaction last year where one of the AAA rated issuer came to the market, and that transaction was driven by RDCL. We have seen one transaction. Uh, that one transaction is unique in the sense that it was the first transaction to be listed in the Indian market, RMBS market to be listed. That was the first transaction put through the EBP platform, right? So that reflects in terms of intent of the regulator or the intent of the government to push for the RMBS market. We have seen one transactions. Probably we'll see more next year. We were hoping that there would be good traction. But again, after one transaction, because of the rate cycle turning, right, we haven't been able to see much transactions in the RMBS market. And on banks, you asked a question on the CD ratio, etc., right? So if you look at volume for last 2, 3 years, right, when we talk of bank volumes, it has been 8,000, 9,000, 10,000 crore of volume that has come from the banking as a seller, right? Last year was aberration in the sense that HDFC, because of the merger and also coinciding with the CD ratio discussion that happened, there was a large volume from HDFC Bank on the securitization side. So if you exclude that volume of HDFC Bank last year, the bank origination have been largely 7, 8, 9,000 crore, right? And what is the incentive for banks to securitize the asset is a big question mark. I can only see one driver. If in a particular sub-segment, the bank has grown too aggressively, right? Then they have benefit of sell down and reducing their growth rate, right, on that sub-segment of the customer portfolio. Otherwise, the pricing that is there for the PTCs, right? It is not efficient for the banks compared to the alternate source of funding, whether you talk of deposit or you talk of, let's say, refinancing, or you talk of any other source of funding. When you compare for the banks, PTCs are not efficient instrument in terms of pricing. So that is what is probably constraining the banks to approach this market. Volumes that we have seen from banks as originators are largely around reducing proportion of a particular asset class from the book.
Okay. Thank you so much, Viniji. I think you have very well covered from domestic market and international market also. I think as per you, we need to have a more robust market actually from all standpoint of view, but it will help to get more volumes in this market actually. So now I'll come to Achintoji. Achintoji, welcome to you. So you are representing from the trusteeship side. Actually, a Catalyst is one of the largest trustee in the country. So we have seen in the past that SEBI has tightened the rules more on the disclosure side and reporting side to the trustee on the securitization. And we have seen that generally trustees are the neutral facilitators for the transactions rather than the active supervisors. So what do you think, that will it change that now the trustees will be more stringent on the supervisory side and the pool performance and compliance side on the portfolio, which will, I think, maybe reduce the growth of the industry, or maybe it will help in the growth of the industry. What are your views on that, actually?
Yeah, thank you, Ashish ji. As a trustee is always a fiduciary body that has involved in maintaining the structure of the transaction. As a in increasing, but the rising volume will have to emphasize has to be correlated and to be at par with the rise in the rise in the case of wherein we complexities are required wherein uniform reporting requirement. Trustee again, we have seen new asset classes are getting involved. Traditionally, what we have seen is asset classes like your mortgage loan or your vehicle loan were preferred choice of securitization. But asset class like your business loan, your personal loan, gold loan, microfinance loan, invoice discounting are getting traction into the market. For each of the asset class, the credit risk and the involvement in the transaction is different. So a specialized or a tailored system is required to as from a standpoint of securitization trustee, ongoing surveillance is uh,
Chintu ji, आपकी आवाज
and
you're breaking little bit, actually. Please continue.
yeah. So as the kind of asset classes that are getting involved into the transaction, repeat issuance by the originator, number of triggers that are required for the transaction to be monitored along with cross monitoring are increasing are increasing. At Catalyst, we handle around 2,400 transactions spread across 130 originators, and each originator has its own parameter of reporting and reporting format. So assimilating those into one format and reporting into a uniform format for the varied stakeholders. You have your PSU stakeholders, you have your private bank stakeholders, rating agencies are involved, FPI investors are involved, all the information and then giving out in a single becomes a challenging ask. So in terms of uniform reporting parameters is required from the originator. Along with that, we also have to keep in look that the data quality that is being reported, as well as the funding discipline, also keep up place with the volume that we are looking into it. So when volume is welcome, we also have to have a control infrastructure at a scale that should support this kind of volume. As far as direct assignment and bilateral PTC is concerned, direct assignment is basically a bilateral transaction, and PTC is generally a bankruptcy remote transaction. So when we are looking at both the requirement, trustee always heavily relies upon the information, the quality of information which the originator or the servicer is providing to the transaction. But when we look at both the transaction, trustee has more control over the PTC transaction. There is a waterfall mechanism involved in it. In direct assignment transaction, it's a borrower level reporting, and it is always dependent upon the quality of information that I'm receiving from the originator or the servicer. With having said that, PTC again has more ring fencing than DA, and again that becomes more attractive to certain kind of investors who cannot invest into DAs. Your non-banking investors alike. when we look at the investors' requirement into the transaction, investors when I started securitization, it was always key P plus I de do. That is principal and interest का information de do. Now the priority has shifted. Amount will always come because the trustee is involved. Trustee will always deliver the money, give us the information. Therein lies the quality of the information that is required. The granular level of information that we're looking at, whether there is any trigger movement, like your par 90, par 60, par 30, whether there is movement in the trigger, cross movement hai ki nahi hai, cross movement in the form of transaction rating goes down, that the same effect has to be provided into our transaction itself. Timely utilization of credit enhancement. That is again one of the aspects which has to be looked into. In the recent experiences that we have, wherein credit enhancement utilization, despite having lean marking, was a subjective aspect wherein we had to go to a certain length to get the credit enhancement liquidated. But if the credit enhancement is available in the form of in the name of the trust, liquidation again becomes a very easy task and timely remittance can happen. And originator doesn't lose out of any benefits in case the FD is kept in the name of the trust. Because the TDS benefit as well as the interest on FD benefit always goes to the originator. Recently, what we have seen is that investors are asking for routing of collection into the collection and payout account rather than having that same available at originator's end to avoid the same of foaming units. So that's how the investors are getting protected in the transaction in the form of collateral availability at the doorsteps of the collection and payout account. As a trustee, we are not just a periodic reporting agency, but we are actively engaging with rating agency, investors, and originator to eliminate in a real-time basis what kind of deviations that we are looking into, and those material deviations can be eliminated before any event occurs to maintain the sanctity of the transaction. So that's how, as a trustee, we are hard pressed on having the collection available into our account in T-1 or T-2, the collection report to be available, the sanctity of the report, the quality of the report that we're looking into has to be as per the documentation. Monitoring of trigger event has to be there. So basically, trustee being a fiduciary agency are moving into a role of proactive enforcement, wherein maintaining the payout discipline, escalating the deviation to all the stakeholders at an early and closely coordinating with investors and rating agency and originator are a proactive activity from the originators. So to answer your question, Ashish ji, that whether there is any change as per the SEBI push, no. SEBI trustee remains a fiduciary activity. All those roles and responsibility remains the same, wherein trustee is involved. Only an added layer of reporting to the stakeholders gets involved in it. However, the core responsibility of the trustee is always there to protecting the interest of the investor. So that's where the trustee is going through.
Thank you, sir. Thank you, Achintoji. I think you have very well clarified your role also, and then the kind of involvement required from the trustee side, that is also you clarified. So thank you so much. Vinod sir, I'll come back to you now. Vinod sir, so we have covered from the regulation, compliance, and the international market also. Now you see that this securitization market is dominated by the financial sector companies majorly in the country. Actually, we have seen one transaction from Reliance, and which is I think 2.4 billion transaction, which is asset-backed securities, basically on the large consumer company. So, what do you think that there'll be the shift also from the financial sector to the large corporates on the securitization side, and what is the regulation on that? So, any corporate would like to go for the securitization. Is there any ecosystem is there in the country, and what do you suggest from your point of view, sir? Over to you, sir.
Mhm. So Ashish the transaction by the Reliance Group entity, I think, is by itself a one of its kind transaction. It's not something which I believe would become a staple diet of the market, because this is a very unique transaction where some investment in an InvIT was being refinanced by use of securitization with kind of call option on one of or three or four of the group entities. So it's kind of a very, very uniquely structured transaction. This is, I would say, as far as the transaction that happened recently, maybe this very transaction might get repeated during the year, or maybe there might be other corporates looking for similar funding, but question whether non-financial entities will have a regular and continuing motivation to use securitization as the route for raising funding. I would frankly have doubts on that. Because for non-financial entities, there are even the corporate bond market itself is a very significant window. Corporate bond market recently have become more receptive to lower rated entities as well, though largely the market still expects AAA to AA rating rated bonds. But there's little receptivity in terms of triple B or single A rated bonds as well. Now, when it comes to non-financial entities, even the rating upgrade, moving the rating to AAA, if there was a securitization by a non-financial entity, that would still be linked with the rating of the originator. In case of Reliance, the story was different because the Reliance Group entities themselves had a AAA rating. Question whether this deal is a precursor to a lot of other deals to come in the future. I think probably the answer might be seems doubtful. But otherwise, a regular flow of non-financial entities. There are plenty of smaller non-financial entities which are still regularly making the forage into the market. For example, rental companies, for example, companies which are funding tuition fees by securitization. Rental seems to be quite a regular inflow in the market. So those non-financial entities, when there was seemingly a lot of setback because of the SEBI's new directions on securitized debt instrument, that seemed like giving an instant initial setback. But I think over a period of time, the market gets accustomed to being on the right side of regulation. I think long run regulated instruments tend to do better than completely remaining unregulated. So that's something that we have observed over a period of time. So I'm guessing that over a period of time, even this SDA regulations will get absorbed in the market, and the market will get accustomed to making everything into a streamlined regulated fashion. There are conflicts, there are overlaps between the army regulations and SEBI SDA regulations. Since I have chaired that committee that led to the SDI regulation changes, I'm aware that the regulators are sensitized on these overlaps and clashes. That's being worked upon. And I'm sure before the end of the financial year, there would probably be some uh, streamlining of the two regulations. Vinayji has raised his hand. I'm sure he would want to contribute further.
Yeah, no, I
Yes,
totally agree
please.
with Vinodji that this is one of we don't expect these kind of transactions to be repeated at a scale at all. These transactions, fortunately, we had the benefit of being part of that transaction. So this was basically not a refinance of the debt, but essentially in any structured transaction, first question that you ask is what is the motive of the transaction. So in this case, the motive of the transaction was that originator could have borrowed on the balance sheet. They didn't wanted to inflate the debt level, so they've gone for this structure. Otherwise, the originator itself was rated AAA. They could have borrowed bond as well. So it's plain vanilla transaction where they wanted to contain the on balance sheet borrowing, and that's how the involvement of Reliance promoter group, promoter shareholders was there in the transaction structure.
Okay, got it. Thank you, Vandriji, for giving your views on that also. So, if I come to Viniji again to you, uh, we see this US tariff and all these things are there, and the, so will it impact the kind of asset which are getting securitized under the securitization? So there are different asset classes are there which are getting securitized, and we have seen the presentation also. There's Wheels is the largest portfolio on that. And do you see any risk also from the subscriber point of view because of these US tariffs, and also that this kind of portfolio should not be securitized and all? So can you just comment on that from the rating agency point of view, sir?
So again, if you look at direct impact of US tariff on the NBFCs, right? There's no direct impact. There could be a second level, third level impact which could flow through the impact on the underlying sectors, right? So our broad understanding on the US tariff is that it did impact gems and jewelries, textiles, right? And SIM exports. These are the three industries which got impacted. And to the extent the linkage of NBFCs, right? Because if you look at market volumes, bulk of the market volume is from NBFCs. The linkage of NBFCs to these sectors is very, very muted, right? If you look at what has hit the industry in last maybe 6 months or maybe year and a half, the number of rating downgrades on the PTC side has been very, very high, right? If you have to look at data in last maybe 6 to 12 months, there have been uh, around 20 instances of rating downgrade of the PTCs across all CRAs, right? If you have to look at similar number in previous year, the number would be maybe 4, 5, 3, 2, very, very muted numbers, right? And if you look at the categorization of these downgrades which have recently happened, maybe close to 20, maybe 75% of them would be microfinance transactions, and balance 25% would be unsecured loans, right? So MFI story has played out in the market that had its impact on the rating of the PTCs, right? And then MFI plus one, which is maybe unsecured loan, right? That also had a collateral impact. So that's the direct impact they could see. Can we say that this was in any way linked to the US tariff? Probably the answer would be no. Uh, a portfolio of some NBFCs who are dedicated on these, right, who have higher exposure to this sector, that delinquency would be there in their portfolio, but nothing to directly impact the rating of the PTCs.
But this will be first time, I think, the 20 rating of PTC have been downgraded. I think we have
In
never
the
seen
recent
earlier.
history, yes. Earlier, if I have to say that, if you have to go back to Diwan bankruptcy, right? Diwan was a large player in the PTC market. So at that point of time, the number of transactions might have been there, which would have gone probably these kind of numbers. But if you leave aside those episodes, right, where an originator has gone bust, right? And if you look at these numbers, right, these are distributed numbers. These are distributed over maybe 7, 8, 9 entities, right? Whereas in Diwan, maybe number of transactions were higher. So maybe 20, that number could be matched in that, but that was linked to one originator. Here
Correct.
we are talking of a slightly, what we are talking here is a asset class related issue, not a originator related issues.
Right. Because PTC, generally, when we are talking to the investors, they are thinking that this is a most secured instrument. There will not be any loss for them, actually. This is the
Yeah.
market understanding, actually.
If you
And
look at rating resilience of PTCs, right? Fortunately, as we are talking, we have few examples of testing the legal framework, testing how the bankruptcy plays out in the Indian context, right? So fortunately, we have instance where Diwan has gone through the process, right? We have ADAG group entities going into stress and then coming out. So fortunately, we have now some data point to say that this is how the courts in India have dealt with the securitization. If you have to take example, let's say Diwan, right? People lost money on Diwan balance sheet, right? But PTCs, I don't think people have lost money on the PTCs, right? Similarly, if you talk of, let's say, a couple of entities of ADAG group which has gone into the resolution process, right? PTC is largely paid out fully, right? And a lot of this is also contributed to the regulation. As Vinod just said, that the market has developed on back of regulations, right? So regulatory framework is such that it is giving a resilience to the market. The regulation of RBI around the reset of credit enhancement, right, gives a huge protection, right, for an event risk.
right. You're right, sir. I think I agree with you. And from originator point of view, I think they are more keen for DA rather than the PTC, actually. So this is the practice also in the country. Because of the classification of asset or income also, both, I think these two factors are there. That's why they are going for more DA rather than PTC actually. So this should be, I think, this is our thought process. The classification should not be different actually, because I think this is creating some kind of ambiguity in the system also. We might be wrong.
Classification for the originator, you're saying, or for the investor, you're saying, sir?
Classification originator actually, originator classification from the asset classification and the income classification also. So if we see that in PTC, this is on book and DA is off book actually.
Again, if you go back, maybe Vinod, you would have a better perspective or handle on this. But if you go to pre-India's era, right, there was some flexibility that regulator has in terms of saying this is the regulatory treatment or this is the accounting treatment for this kind of transaction. Probably, again, I could be wrong. Vinod, you can correct me. Post India's, that discussion is not there with the regulators, so now they are more prescribing on the capital requirement on a transaction rather than advising on the accounting treatment, right? So accounting treatment now, fortunately, unfortunately, driven by what the accounting guidelines says, and RBI probably is staying away from any tweaking in that. Maybe Vinodji can add; he would have a better perspective than me on this. Yeah,
You're absolutely correct, Vinitji. The RBI has no intervention when it comes to accounting standards. It says very clearly that if the originator follows Ind AS, then the Ind AS balance sheet will be adopted for all regulatory ratios, except in the case of capital adequacy. Capital adequacy is the only exception because sometimes we book, for example, gain on sale or sometimes book fair value gain. That will not be acceptable for capital adequacy purposes. Other than that, for all regulatory ratios, the accounting standards will prevail. RBI has no intervention in that. And the only point that we need to note is that it's not that securitization cannot be off the balance sheet. That's a wrong perception because transactions in India in the past have been so structured that most of them did not qualify for off balance sheet. Off balance sheet is basis certain risk and reward transfer requirements, which are stated very clearly in the India's 109. And if the transaction complies with that risk reward transfer transaction, risk reward transfer requirement, it may still qualify for off balance sheet. I'm guessing that this year there might at least be one or two transactions which actually which are PTCs and yet they qualify for off balance sheet. That's something that we're waiting to see, but I'm hopeful that this time we'll probably have some those transactions as well.
correct. I agree. Sometimes I wonder that when they say risk and reward, we have historically been taught of credit risk. Now, credit risk on a portfolio is 100 rupee portfolio, 100 rupee credit risk. Somehow people are interpreting that this is the loss and this is the credit enhancement, and they say loss is lesser than the credit enhancement, hence entire credit risk is with you, right? Somewhere loss and credit risk are different. Probably again, I don't think we can reopen that, but that's probably a fundamental
No,
disconnect that I have in my mind. Risk is
the point you're
100%
making
risk.
is
Yeah.
the point that you're making is absolutely valid, Viniji, but there are two things we need to see. Number one, we need to see the proportion of expected credit losses and the extent of credit support, credit
Right.
enhancement. And we mostly find the credit enhancement is several multiples of expected losses. That part one. Part two, the entire excess spread, which is the reward, flows back to originator mechanically. So the structures do not innovatively deal with each of these. A, we don't have multiple assets, we don't have multiple rated categories. We have only A and B. Typically, in global situations, we have A, B, C, D with several classes.
Several
Therefore,
classes, right.
the extent of retained risk of the originator is much lesser than we have in Indian transactions. Number
Right.
two, in most global transactions, the flow of the excess spread is in form of something called IO strip, which we
Highest.
don't have in India. Most transactions don't have it. So if transactions were to be innovatively structured, I am hoping that they may still qualify for off-balance sheet as well.
Oh,
Okay. Great,
let's
sir.
hope
I think
this will be innovation in the market.
that's a new development actually. So, sir, I think we have covered many things from the regulation, risk, and other things also. There is one question from the audience, and this is related to the green securitization. So they would like to just understand what is the progress on the green securitization till now, what kind of transactions are happening, and what are the benefits to the sewer and the subscriber in case of green securitization. So, Binit would you like to cover on that, or Binodji, or this Achintoji? Because this is something new which
I can give my view and then Vinodji can add. So the number of transactions on green side have been very muted, right? This is an evolving asset class. To what extent it evolves, probably we'll have to see in time. In terms of benefits, uh, there are a certain class of investors who prefer green, and to that extent, it gives the originators ability to diversify the investor base, and they might be able to get some pricing benefit. So that would be the benefit on the margins. We don't see a very disruptive impact of this on the market volumes or anything like that. Again, Vinodji.
I think I completely agree with Viniji that globally, there is yet to we yet to have SEBI's exact definition of what will qualify to be a green ABS.
Right.
SEBI came with a proposal. It's not been implemented as yet. I think it's very shortly in the process of getting implemented. There are two viewpoints here, whether we take it green based on use of the proceeds or we take it green basis the collateral class. For example, the collateral class might be EV, that's green because of collateral class. Or I might say, whatever might be the collateral class, I will use the funding for making green investment. So use of proceeds or the collateral, these are the two perspectives. Globally, European Capital Market Association, ICMA has taken both the ways. You can take it either based on end use or take it based on collateral class. In India, our suggestion has been that we have significant volume of asset class itself. I mean, green funding, for example, quite a lot of EVs being funded in India, quite a lot of green buildings being funded in India. Therefore, we suggested that it should be collateral based, not based on use of proceeds. So that's still under process by SEBI. So partly it's lacking a regulatory clarity, one part. Secondly, as you rightly mentioned, while there is a demand for green bonds or green assets, but not that significant so as to lead to a very significant greenium. So greenium is not, even in Government of India green bonds, we did not see a significant greenium.
Correct.
So greenium is yet, and therefore motivation in terms of lower cost of funding, that is yet to be seen.
I have one question for the panel. Do we see replenishment coming into picture for other asset classes? Replenishment is primarily more prevalent in your gold loans or your vehicle loans. Recently, we have seen on transaction, RMBS transaction, where replenishment structure came into existence. So, do you see replenishment as a way to enhance the pool quality or being introduced into different asset classes?
Should I be responding to this?
Yeah,
Yes,
please.
I can.
Huh. So replenishing structure world over is used for short tenure asset classes. The purpose of replenishing structure is to convert a shorter term asset into a long term security. For example, credit cards or microfinance loans or gold loans, short tenure loans. We need to elongate the funding, therefore we go for replenishing structure. Use of replenishing structure for anything which is inherently long term, that is very unusual. That apart, as Mr. Chinto mentioned, use of replenishing structure to strengthen the asset quality. No, that's never done. There is no question of using any structural, features to enhance the quality of the pool, because the very definition is the selection criteria basis which the assets are selected will remain static. The pool will change, but basis the same selection criteria. Therefore, initial selection as well as ongoing selection will both be done on the basis of same selection criteria. However, the problem with a longer term asset, for example, home loan, using a replenishing structure is that the loans that are buying, say in the third year, will also have a 5-year, 10-year term. So
Yes.
when will they actually wind up the transaction? Replenishing structure has two tenures, a revolving period and an amortization period. During amortization period, we should be able to wind down the assets quickly. If I'm buying a longer term asset later in the tenure of transaction, the winding down of the transaction becomes very long. So that's reason why mostly in any transaction anywhere in the world, longer term assets are not used, or replenishing structure is not used in case of longer term asset classes, mostly for short term asset classes. Mr. Chintu.
True. I totally agree that replenishment can't be acting as a better collateral, better pool. B, it is used to elongate the maturity of the asset. And you are right, Chintu, that in let's say last year or so, we are seeing more of replenishment. Is it a sizable number? It is not, but is it a higher number compared to earlier? Yes, it is, because now RBI guideline specifically recognizes replenishment. It is not, it was not allowed earlier, but a specific mention is mentioned in the guideline gives confidence to investors to try this. So there are more transactions on replenishment side, but again, only to elongate the maturity. And even in home loan, like Vinod ji said that it really doesn't make sense. So even in home loan, couple of transactions that you've seen has got repayment period of maybe 1 year, 2 year only. Beyond that, you have to stop. So essentially, they are saying that to keep the maturity to maybe 7, 8 years. That's how it is.
Thank you. Thank you. Thank you.
So, friends, I think thank you so much. I think it's a great discussion. I believe you must have got some kind of information, understanding, better understanding also. A panel speaker have spoken from the very straightforward point of view. They have given the reply of all the questions also. They covered up all the questions very well also. And you have discussed many things, many aspects which are regulatory and the new things also. And I think keeping in mind the current year, current half of this year scenario, thinking the end of the year will be very good from the securitization point of view. We'll surpass the numbers of the last year. Definitely, it looks like that. And the kind of structures are coming, which are new structures, RMBS and all. These things will help us to grow the market volume also, and the agencies like trustees and the rating agencies will help to structure these transactions also. And I would like to thank you to the all the panel speakers, Vinod ji, Vineet ji, and Chintu ji. And in the absence of Mr. Rani, I think she could not join. Actually, I'm really sorry for that. Actually, she got some problem actually, so she could not join. And I would like to thank you to all the people who have joined us in this today's webinar from the different part of the country and from outside India also. And they make it more interactive also. They ask questions also. And I would like to thank you to the resurgent team also. Those have made it successful. Because they have organized this seminar, this webinar, and they could bring all of us at one place and we could discuss on that. This is a baby step, very small step, I believe. It not be a very large step, but I think the small steps will definitely help to get the better understanding with all stakeholders. So I would like to thank you to all the people who have participated in this actually, and from our side, this Parisa or the Subham and the other DMT member, Joginder, Ankit, and Mr. This thing, Viswesar ji and all. So thank you once again to all of you. We look forward the great journey in this securitization market, and new product, new instruments will also come. And hopefully this will grow further and further actually. And someday we will be looking like a US market where the banks or the investor will look at it from long-term asset point of view rather not from a balancing of the books actually at the end of the year or from the CD ratio point of view. So thank you once again to all of you. And thank you, everybody. Good evening, everybody. Thank you so much.
Thank you.
Thanks,
Thank
sir.
you.
Thanks a lot,
Thanks.
sir.
Thanks a
Thanks.
lot.
Thanks a lot. Thank you.